Hey everybody, it's Elizabeth Rose, and I have been playing around with this new computer, new Windows, latest, greatest. I don't like it. It's driving me crazy, so I'm trying to record a video here, a little tech challenged. Anyway, looks like we're working now though. So I wanted to have a quick conversation today about the mortgage rate environment and its relationship to the election, because I hear so many comments out on the street. This happens every 4 years. People thinking that as soon as the election is over, I don't know, the next president, the Congress, the Federal Reserve, somebody's going to hike rates. And I wanted to dispel some of that and explain really what we see in the mortgage market and where those rates are derived. So the Fed has one rate that they have control over, and that's the Fed funds rate. And they have a dual mandate to maximize employment and keep prices stable. They do that through the manipulation, if you want to use that word, of the Fed funds rate. Well, that's over here. That's a separate thing, and it's not where mortgage rates come from. Now, mortgage rates oftentimes react to things that the Fed does, and or its statements that it makes and so forth, but that's just one small tiny thing that influences bonds or mortgage bonds, and it's tiny. It's just one of those things that happens whenever a Fed member speaks, whenever there's a meeting, whenever there's minutes released and so forth, and it's usually a knee-jerk reaction, and then bonds settle back down to their typical trading pattern. So mortgage bonds are where mortgage rates are derived. Mortgage bonds are backed by mortgages, and they're held in portfolios. You may have some of them in your 401ks. Many people do. And they're traded on Wall Street every day, all day long, from open to close. They're moving up and down, and they're pretty volatile. And they're just like a treasury bond, a commercial bond, a municipal bond. So they're an instrument. And what we see happen is, just like with any commodity, you've got supply and demand, you've got buyers and sellers, and you've got these price negotiations that are happening all day long. Add to that mix inflation, and inflation is the biggest driver of the direction of mortgage-backed securities. Mortgage-backed securities absolutely hate inflation. And so when inflation is present or it's creeping higher, you'll see a negative reaction from bonds. Bonds respond to good economic news badly, and they respond to bad economic news very nicely. So when life is good, mortgage rates are going to be higher. When life is not so good, mortgage rates tend to drop lower. And then inflation is the biggest component, the biggest driver of the direction and even the speed of that direction with regards to mortgage bonds and mortgage rates. So right now we have essentially no inflation, although you and I would probably argue that. But and that's a whole another conversation, how the Fed deciphers that or reads that information and what they look at to manage. And sorry about that, my phone. Anyway, what was I talking about? Inflation. So inflation is the key component of the direction, or the key indicator of where we're headed with interest rates. So if you want to know what's going to happen after the election, nobody's going to flip a switch and jack rates higher. It's all going to be dependent upon what's happening with inflation. We have not had any significant inflation in so long. The Fed has tried everything that they could to set it on fire, and nothing happens. It's just flatlined almost. And so right now, with very little inflation on the horizon, they can't seem to ignite it, get it off the ground. It's below its target range. I just see mortgage rates trending pretty close to a sideways pattern. I think there is a chance for them to move slightly higher, but higher how much? An eighth, a quarter, a half, maybe not. But it's all relative too. So anyway, I just think that you need to take a chill pill and not worry about it. Nothing dramatic is going to happen after the election with regards to mortgage rates. So there you have it in a nutshell. Anyway, if you have any questions, give me a shout. Maybe one day we'll talk about the Federal Reserve and how they look at that inflation number. Maybe we won't. I don't know. Anyway, have a great day. See you later. Bye.